What's up, future millionaires? Welcome back to another video. Today, we're going to be going over two very important topics if you want to become a value investor. Value investors are going to make more money over time if you follow these two things. Let me get real with you though. If you feel too nervous to lose a good amount of money in the stock market and take higher risks, then you do not want to become a value investor, and this video might not be for you. There are some people where because they don't have a high risk tolerance, I would suggest they just invest into simple ETFs like the S&P 500. So if you're not willing to take a bit of a higher risk for a bit higher of a reward, then this isn't for you, and that is totally okay. I have created a video series teaching you what the stock market is and how to invest on it on a simple level, and you should definitely go check out those videos. I'll put them down in my description. So if you're not ready to become a value investor, please go watch those videos. I promise that you will love it. You probably saw from the title of this video, but today we're going to be going over what intrinsic value is and what a margin of safety is. So without further ado, let's teach you them, and then I'm going to give you an example on how to mathematically solve them. So say there was a company called XYZ Inc., right? And their stock chart looked something like that. This company's value doesn't actually look like this over time. They didn't actually gain that much value and lose that much value in reality. This stock chart is what people value the company at. So in reality, the true value of that company, which is called their intrinsic value, is going up at a much more steady rate. What you want to do as a value investor is you want to look for times in this chart where you believe the value that the stock is being sold at is below the intrinsic price that you believe in. And I'll show you later in this video how to calculate the intrinsic value of a stock based on your assumptions. So let's give an example with XYZ Inc. Say after doing your calculations, you would say that the intrinsic value of this stock sits about like this. So you think that over time, the value of this company has looked like this. And let's say right here, this company was overvalued, or right here, overvalued. Right here, overvalued. But all these times you think the company is undervalued. All this time under this line is undervalued, right? Off of your beliefs on how the company will do in the future, this is what you think the company is valued at today. But that's not it, because as an investor, the best investors know that they are wrong sometimes. And that is where we get to our next point, which is margin of safety. To put it simply, a margin of safety is buying a stock a percent below the intrinsic value you believe that stock is. So if you believe that this stock is $100 and your margin of safety is 20%, you are saying you will not be purchasing this company until it was below $80. So what you want to do is then have your margin of safety, and it might look something like this, right? Your margin of safety is going to sit below the intrinsic value. So take a time right here. It is below your intrinsic value, but it is above your margin of safety. So here, you're not going to buy it. Or here, it is below your intrinsic value, but it is above your margin of safety. So the only times in this chart that you would want to purchase this company is here and here. Any time during this was all a good time for you to buy. And the thing about margin of safety and intrinsic value is that it makes it so that you make more money over time. There were a lot of times for this stock where you could have lost so much money, right? This stock is all over the place. Say the present was like right here, right? And you were like, oh my gosh, I love this stock. It's going up so much. You see how much it's just growing and growing. So you buy here. And then all of a sudden you have tanked and you went all the way down there. Horrible. You could have avoided this if you had calculated its intrinsic value and realized it was above it, and it was even more above your margin of safety. But when buying below your margin of safety, you would get in at prices like here or like here, and look, you're just making money. Easy. The last thing that I want to explain when it comes to intrinsic values and margins of safety is how to buy it. So say you were right here and the stock falls below your intrinsic value, so you start paying attention to it, right? You realize, oh man, this could be a buy. Then it actually gets below your margin of safety. You're right here. What do? What you want to do is dollar cost average. And I know I've explained this in previous videos, but if you don't know, dollar cost averaging is to buy a stock every time over a set amount of time. So maybe it's you buy one share once a week or 5 shares once a month or whatever you want. So then with dollar cost averaging, you would be like, I'll buy here, you buy here, you buy here, you buy here, and you just keep buying. And what you do is you keep buying this stock, and then once you see it leave your margin of safety, so maybe the next week you check and it's right there, and you go, no, I'll pass. It's above my margin of safety. I don't want to take the risk, because the risk is, what if the stock, instead of going up like this, what if it, went down? And then, you want to be safe and not buy that stock above your margin of safety. And what's so good about dollar cost averaging is now you've gotten in at an average price of about right there. So if the stock is below this line, you're losing money. If it's above it, you're making money. So now, say the stock did and it crashed, boom, all the way down to the bottom, you only lost this much money. Whereas if you had got maybe excited, bought here, you would have lost that much money. Huge differences, guys. We're going to go to an example of how to mathematically solve the intrinsic value. This is so valuable. This is how you're going to have your losses be this instead of be this. It is amazing. Value investing is so important. And if you don't believe that it works, take Warren Buffett, whose net worth is over $100 billion. He is not a guy that's like day trading. He's actually a value investor. So value investing has been so proven, and it is so simple in comparison to more risky things like day trading. So without further ado, let's go make you an above average investor. For our example, let's say that there's a hair salon on your block, and it's owned by a girl named Crystal, and she wants to sell you 10% of her business for $60,000. This means that she is valuing her business at $600,000, because if $60,000 is 10%, you change that to 100%, it would be $600,000. But now you might be there in the moment and be like, I don't know, right? So you go home and you're like, I want to buy a piece of a business, but I have no clue how to value this business. Well, look no further, guys. You found a video for it. So I'm going to show you with that example how to value her business. So the first thing that we want is to figure out what the past 5 years of the business's free cash flow has been, right? So in this example, we see that in 2018, Crystal's hair salon had $40,000 in free cash flow. We also see that in 2022, they have done $52,000 roughly of free cash flow. Just a reminder, free cash flow is how much money a business has left over. So if they're selling a product and it's $100, and after all their expenses, they have $50 left over, that's their free cash flow. The next thing you want to do is take those past 5 years of free cash flow and calculate the average that they have been growing at. In our example, I made it super simple and it's been growing at 7% a year. But not all businesses are going to be growing at such a steadily rate, so you're going to need to calculate it when looking at publicly traded companies. And then we take those past 5 years and calculate what the next 10 years of free cash flow are expected to be. So for instance, we can see that in 2028, we can expect, growing at 7% a year, that this business will have roughly $78,000 of free cash flow. This is very important because it shows how much this business will scale, and it shows you if you want to get along for the ride, right? So if a business is only growing at 2% a year in free cash flow, you're not going to see much growth. So your value, your piece in that company isn't going to grow either. Now, this might all seem simple so far, but this is where it gets a bit complicated, but trust me, it is so worth it. Let me ask you a question. Would you rather have $100 right now or $100 in a year? If you said $100 in a year, you're crazy. Everybody will take $100 right now because money right now is worth more to you than money later. So what we need to do is discount future free cash flow, because every business is valued at the present value of their future free cash flow. That sounds complicated. I know it does. But what you're basically going to do is you're going to take what you value that business's future free cash flow, add it all together, and that's the value of the business. Kind of. I'll explain. So back to Crystal's hair salon, we now have a new section, right? We can see the same future years, but how much we value the free cash flow at. Whatever you discount your free cash flow at, say it's 10% annually, that is how much you are trying to make owning that business. So if you discount all the future free cash flows at 10%, you are trying to make a 10% return in owning that business. Usually a good benchmark is about 12.5%. For this example though, we discounted it at 15%. The way you calculate this is that you take the future free cash flows and multiply it by the discount. So an example would be in 2024, your equation would be $60,029 times 0.85, because that's minusing 15%, right? Because that's how much it is off of 1. So when you get 1 and minus 0.15, you have 0.85 left over. So you're going to take $60,029 and multiply it by 0.85 squared. And the reason you're doing squared is because that is 2 years into the future. So if you took, for instance, 2028, you would be going and doing $78,686 and multiplying that by 0.85 to the 6th power. I know this math might be slightly complicated, so if you need help, please write it down in the comments section. I will more than help you if you have any questions on this. It really is simple once you get it. Okay, so once you have all those free cash flows discounted, which might take a little bit, this probably took me 20 minutes or something like that, you are going to take the last year, the 10th year, whatever is 10 years away, and times it by the business value that you want to sell at. So a publicly traded company will usually sell for about 11 to 15 times their earnings, right? But if you are getting into a riskier business, you usually want to be at a lower multiple of their future free cash flow. So if a business has $100,000 in free cash flow, you want to buy at a lower multiple if it's a smaller company, which in that case it is. But if they had $1 billion in free cash flow, you probably want to buy at a much larger multiple because you're not as nervous about that business going bankrupt. So in this example, we used a multiple of 10. So what you're going to need is a new line, and you're going to name it business value, right? And the first thing you can do is see what the business would sell for in 10 years, right? So we can see that if we do at 10 times our free cash flow, in 10 years, this business sells for just over $1 million, right? So our stake of 10% would be worth roughly $100,000, okay? And then what you're gonna do to figure out what price you wanna buy into is you're gonna take the 10 years away, right? So the 2032 discounted, and multiply that by 10 and put that in the business value line, okay? So take that first and put that there. Then what you're gonna do is you're gonna take all 10 years of free cash flow discounted plus that times 10 number you just got and add them all together. And that number right there is how much you should pay for the business if you want to make 15% a year. So for instance, this business is currently valued at $525,000, right? That's what we believe its intrinsic value is. So what are you going to do with this now, right? You're going to go, well, first of all, I want a margin of safety, right? Because you, as an investor, once again, have to assume you're wrong sometimes. What if for the next 10 years, they do 5% growth in free cash flow? Suddenly, you're not going to make those 15% returns. So you want to give yourself a smaller downside by buying in at a lower number. So going back to our example, let's say we buy at a margin of error at 20%, meaning that we want to buy the business 20% below our intrinsic value. What you're going to do is multiply it by 0.8, which once again, that's that 0.2, the 20% off of 1. So multiply it by 0.8, and we'll get that this business should be purchased for roughly $420,000, right? So now you have it. This business should be bought for about $420,000. So what do we do? What do we tell Crystal? What we got to do is figure out what our 10% of the business is worth. So in this example, because 10% is, well, 10% of 100, we're going to take it and divide it by 10. So 420,000 divided by 10 means that we should be buying 10% of the company at $42,000. So going back to Crystal, we're probably going to say no, right? Because she is valuing her business at $600,000, and she could be right, but we disagree and are valuing this business at $420,000. So maybe we do offer it the way, hey, I decline your offer, but I will buy 10% of your business for $42,000, right? Finally, we must understand how this translates to stocks. Stocks are not split up into 10, right? There are not 10 shares of companies. There are billions or millions. So instead, what we're going to do is we're going to take what we believe the business is valued at. Let's say it's $500 billion, right? And then we go look at what the stock market is valuing it at its market cap. So let's say after our margin of safety, once again, we value a business at $500 billion. You go and check that market cap, and they're currently valuing the company at $400 billion, right? You're going to go, oh, that's awesome. It is below my margin of safety. So you're going to calculate whatever your margin of safety is below your intrinsic value. And if the stock is below your margin of safety, that is when you're going to buy it. It's really that simple, guys. Once you get past the math, it is so easy and so valuable. As we saw in that drawing, you, by being a value investor, do not have to take as big of risks, but what you do have to have is discipline, right? If you get scared because you're buying below your margin of safety and you're like, why is this business so low valued? Then you're not seeing it as the opportunity it is, and you just shouldn't be buying it. You have to know if you're ready for this. Not everybody is. When I started investing in the stock market a few years ago, I would never have wanted to be a value investor. That would have freaked me out because I was scared to lose like $100. Back then, I needed the reassurance that I wouldn't lose that much money. But the cost of that is that I wouldn't be making that much money. With value investing, you set yourself up almost like a slingshot. Even though you're so low, it's just gonna shoot straight into the sky and you're gonna make a ton of money, guys. And as always, thank you for watching this video. If you have any questions, please leave them in the comments down below. And now I'm really gonna start talking about individual stocks in my videos. So if you have a company you want me to go over from a value investor point of view, please let me know. And I will go and tell you the intrinsic value and so many more things. Because guess what, guys? I have something coming up next week and I'm gonna be sharing the future of this YouTube channel. And trust me, it's gonna be amazing. You're gonna wanna stick around for it. For that reason, you gotta like and subscribe because this channel is just the beginning. I have like 21 subscribers right now, guys. This is just the beginning. We are gonna grow together and our money's gonna grow together with it. Thanks for watching this video.